Bismillah ar-Rahman ar-Rahim. Today I'm going to talk about the portfolio theory and the CAPM, capital asset pricing model, and finally the arbitrage theory. So we have two things to focus: the portfolio theory and the capital asset pricing model. Before discussing the portfolio theory and to link between the diversification and the portfolio theory, it's preferable to talk about the diversification and asset allocation, just to link between them. As I explained before, diversification is diversify our assets into different asset classes. For instance, we can invest in stocks, in bonds, in real estate, in currencies, and other things. The question is, what is the optimal portfolio that we can invest in? How much to invest in stocks? How much to invest in bonds? How much to invest in the currencies, for instance? Okay, if you talk about the stocks, what are these stocks? If you talk about bonds, the categories of bonds, and if you talk about the currencies, some people, they categorize the portfolio based on the liquid and non-liquid assets. Okay, for instance, this is cash assets or liquid assets. Liquid assets like short-term securities like CDs, treasury bills, commercial papers, euro bonds or euro dollars, and other things. The non-liquids is like long-term, including the stocks and bonds. This is, you can talk about liquid versus non-liquid. Some portfolios based on international diversification. International diversifications. For instance, invest in emerging countries and in developed countries. Okay, for instance, 30% in the emerging countries like China, and developed countries like in the UK and United States. Okay, so we have different portfolios with different objectives. If you look at here, financial planner may recommend that a client construct a portfolio of 10% liquid assets, such as money market, as I explained, 30% in emergencies, and in fixed income. So it's important in terms of having optimal portfolio to look at the different combination of the assets or of the portfolio. If you look at the stock components, as I explained, if you think this is stock and this is bonds, you can look at different categories of stocks. You have small companies, you have large companies, and so on. In the language of investment, you can use small cap, large cap, medium cap. Like in your last exam, I said you polish. It means you buy. So when you talk about you be rich, it means you sell. The same things. When investment has its own language. When you talk about small caps, it means small companies. You talk about large caps, you talk about large companies. So some investors or dealers think having 1/3 in large companies, 1/3 in smaller companies, and 1/3 in foreign securities. Okay? In terms of foreign stocks or international diversification, you can categorize or have a combination of emerging economics like China and developed economic like Japan, okay, or United States. A portfolio of 60% stock, 30% bonds, and 10% cash should help achieve diversification. This is, you have different combination of different categories of assets. The optimal portfolio, which is the portfolio satisfy the investor behavior or the investor requirements. You can see this, the portfolio can 30%, 45%, and the treasury bills. Now the portfolio theory. The portfolio theory is developed through the work of Markowitz, Sharp, and many others. So the key authors of the portfolio theory in back to 50s and 60s and 19s by the work of Sharp and Markowitz. The importance of the portfolio standard deviation, they use the standard deviation of the portfolio and the expected rate of return. So both of them determine the optimal portfolio and determine the attainable portfolios. Attainable portfolios is the portfolio that we can invest our money with it. Markowitz, this is the most important guy who talked about the portfolio, the first one, and then it developed through the work of Sharp. The Markowitz model is premised on a risk-averse individual constructing a diversified portfolio that maximizes the individual satisfaction. The main objective of the portfolio is the portfolio which maximizes the utility of the investors. Unfortunately, in your textbook, it is not addressing well the concept of utility. So what it means utility? Utility is the link between the rate of return and two things. The investor preferable toward risk or behavior toward risk and the standard deviation. In this case, the utility is a function of the expected rate of return minus half of A sigma squared. This equation is not in your textbook. To determine the utility, which is the level of people's satisfaction or the investor satisfaction, is determined by to what extent people asking or required the return minus the A, which is here is the investor, the risk aversion. A is equal the risk aversion. Risk aversion is measured by the attitudes of investor regarding risk. So people with high A is mean more risk averter. People with a low A, it means people with a lower risk aversion. It means when people having A equals 0, it means risk neutral. If people having A minus, it means there are risk levels. So this the scale of A is like this: people risk averter, and here is risk levels in terms of A. So the utility is equal the expected return minus half A sigma squared. So the utility is a function of your required rate of return, what you're asking, minus what the risk that you hold. And the risk that you hold is a function of your A, your attitude regarding risk, and the sigma squared, which is the variance or the variance of the stocks or the portfolio. in this case, generally referred to as utility by economists, by maximizing portfolio returns for a given level of risk. And by economists is determined by the indifference curve. People have different utility, they have different indifference curve. Okay? So let's find this equation. So everyone has his or her utility based on A. Okay? And the required rate of return and the standard deviation, or the sigma squared. The Marquis portfolio depends on the selection model. The first step is to determine the risk return opportunities available. What are the risk return? The risk, okay, this side, your right hand side is the risk, and your left hand side is the return, is a function of the relationship between risk and return, but we add new things for the risk is your preference to risk, or risk preferences. Okay? All portfolios that lie on the minimum variance frontier from global minimum variance portfolio and upward provide the best risk return combination. We will explain this by using this chart. Look at this chart. What you observe. This line connects between X and Y. What exactly mean? X is starting in this and Y is in here. It means we invest 100% of our portfolio from X. And in Y, it means 100% is Y. So we don't have portfolios in, by the way. It's mean when we having stock X, 100%, we don't benefit from the portfolio. This is X. And we have Y, this is Y. If we invest in X, we have this return and we have this risk. If invest in this, we have in Y, we have this risk and we have this return. When we are moving from X to Y, it means we are adding more Y's to the portfolio. And if we are moving from Y to X, it means we are including more X to the portfolio. So at any point in this line is a combination of X and Y. The closer you are in X, it means more weight to X. The closer to Y, it means more weight to Y. If you take B, for instance, which is in the frontier, and I will explain what it means in the frontier, B is like this. Around, let's see, 70% of Y, okay, 70% of Y and 30% of X. If you take this point, for instance, it could like this, 30% of X, of Y, and 70% of Y. Okay. So just to know the, and if we use Excel, if you use Excel and having the return, the expected return of X and the expected return of Y, okay, and try to use different combination, you will have this frontier. So this frontier line represents the all efficient portfolios on this line. Okay? Now we have portfolio A, portfolio B, and portfolio C. Let's start by talking about A and B. This is the vertical line is for the expected return, and the horizontal line for the risk. In this point of risk, in A, if we invest in A, we will have this return. But in the same point of risk, we will have higher return. So in this case, B is more preferable than A. What about C?
Not attainable.
It's not attainable because it is out of the reality. For instance, if you have 10 apples for 10 people, if I ask you what about the 11 apple, we are talking about reality. We only have 10 apples for 10 students or for 10 people. So C is not attainable. It's not attainable in the financial markets. Okay? And we could have more portfolios around here. The most important things is the frontier line, which locates all the possibilities of the portfolios. And all of the portfolios located in this line are efficient. But the big question is now, which is more preferable? This one, or this one, or this one, or this one? Yes. To answer this question, we should include the indifference curve, because it determines the efficient portfolio. So the efficient portfolio, the portfolio that maximizes the return at the minimum level of risk. And this is much related to the concept of the portfolio management. Okay? Any question?
دكتور.
Yes.
بالنسبة للإنفستور يعني بيضل الخيار بين A و B.
Yes, but why you invest in A if in the same level of risk you have B, giving you higher return? Okay, let's take another point. If we have Z here, and if we have this, for instance, F, which you prefer, F or Z? Okay, if you have a point here, in the same level of risk, you may have this. So why you invest on? So this is for irrational investors, and this is for rational investors. Okay? So the frontier line is helping you to find out the efficient portfolio. As you see, all portfolios, example B, X, Y are efficient. Highest return for the level of risk. Okay? We could find portfolios on this area, with the shadow area, but the most important is to find the one is located on the line. Some of these portfolios are inefficient because they offer an inferior return for a given amount of risk. We explained this. Any portfolio, example A, below the XY is inefficient. So if you go back, any portfolio located in the shadowed, inside the shadow area here is not efficient. Because we could find in the same level of risk more return or more expected rate of return. So any portfolio on the efficient frontier is acceptable in the frontier line. So the investor can have only one of the efficient portfolios. The portfolio combines the efficient frontier, okay, and the investor's willingness to bear risk. Go back to my equation when we talk about the utility, and just translate these two functions or these two concepts into the equation. For when we say the utility is equal the required rate of return or expected rate of return minus half of A sigma squared. Look, the efficient frontiers, the portfolio combines the efficient frontier, the investor's willingness to bear risk. Is not only the risk, the willingness to have risk. It means to attitude regarding sigma. So this is sigma. What is my attitude to sigma? Yeah, this is my attitude to sigma. So we are not looking to the sigma itself, but your behavior regarding sigma. Okay? It doesn't mean you have the swimming suits, you are a good swimmer. So the attitude regarding the swimming This is the most important things.
Risk avoided or risk?
Yes, you are avoiding risk, or you are loving risk, or you are neutral regarding risk. It means it doesn't matter the level of risk for you. Okay? And people with the risk and neutral are gambler. Okay? They take risk for enjoying. They are not considering the... we have different level of indifference curve. As explained, the willingness to be risk is determined by the indifference curve. The higher I, so we have I is represent the indifference curve. Okay? So in this case, people located in the same indifference curve, they have similar efficient portfolio. But because they compare, this is sigma B1 related to the, if they want to hold higher risk, they have to require higher return. If they are moving to I2 is more preferable, and then if they are moving to I3 is more preferable. But depends on the attitudes regarding risk or regarding sigma. So indifference curves, superimposing the difference curves on the efficient frontier determines the investor optimal portfolio. So the importance of this is how to locate our optimal portfolio. If we back to our frontier, as you see in here, the big question is, where the optimal portfolio? So the optimal portfolio is determined by the indifference curve, by your attitude regarding the risk, as you see here. My big question, could our optimal portfolio located in I2 or I1 or I3? Okay, so the good news for you is, I'm not asking you to calculate this, but if you are interested, okay, we give you the equation by which you can calculate the optimal portfolio. And this equation is looks like when you calculate the sigma B. You know what I mean? Okay? Okay, you spend your time on understanding this. So in indifference curves, investors would like to earn higher return without having to bear additional risk. This is the indifference curve. People would like to have this point of return, higher return with having no additional risk. A higher return with additional risk increases total satisfaction without additional risk. When we have, it means you prefer to have higher return with no additional risk. This is the indifference curve. Higher levels of satisfaction are indicated by indifference curves I2, I3, and I1. Look back. When you go up, it means you have higher level of satisfaction. So in the same sigma B, if you go up, you ask in the same level of risk, higher return. In the same level of risk, the higher return. Once again, the investor is indifferent. People are not the same, or they don't have the same attitude regarding risk. So it's indifferent between any combination of risk and return on I2. All combination of risk and return on indifference curve I2 are preferred to all combination of indifference curve in I2. Let's go back. So any combination of I2 is more preferable than any combination of assets in I1. Similarly, any combination of I3 is more preferable than I2 and I1. Okay? So, by using this, we obtain the optimal portfolio, which is all. And what about I3 is not attainable. But below the I2, you can attain the I1, but as I explained in the previous slides, at any point I2 is more preferable than I1, and we only have one optimal portfolio based on the investor attitudes. So in this point, regarding the attitude of a particular investor, this is more preferable to any point in I2 and any point in I1. Okay? Please read these things carefully. Okay? So the optimal combination of risk and return represented by point O, this is point O, which is the optimal portfolio, is the investor's optimal combination of risk and return. Portfolio O must be preferred to B and A. Okay? And is preferred than I3 because I3 is not attainable. Okay? This leads us to talk about the capital asset pricing model, the CAPM. The CAPM is the developed version of the Markowitz model. Is the developed version of Markowitz model. Okay? The problem of Markowitz is not considering the different classifications of the portfolio. In the capital asset pricing model, indifferent curves cannot be observed because it's related to the A. Let's go back to the equation. Expected return minus half of A squared. So this A is not observed. What it means is not observed. It means we cannot read the A of people because it's hidden behind their attitudes and their behavior. And this is the problem of the Markowitz model. In other ways, we cannot measure the people's satisfaction. And the satisfaction of investors is keep changing according to the attitude of risk and the attitude of return. Okay? So this is the importance of having the capital asset pricing model. So in the capital asset pricing model, we don't need to consider the utility function or the indifference curve. Virtually impossible to use in an operational model using indifference curve. Yes, it's in the economic theory and it has many applications in the economic theory, but at the end of the day, how we include this in the equations. This is why the capital asset pricing model have the prestiges of the finance. Maybe you are the first time to know about the Markowitz model, but the Markowitz model is the first step in the train of the capital asset pricing model. The capital asset pricing model come to develop the ideas of Markowitz. So the CAPM makes the theoretical trade-off between risk and return operational, and in addition to this, they give the practical point of view as well. Capital asset pricing model that links the notions of risk and return, helps investors define the required rate of return on an investment. If we look at the capital asset pricing model, represented by the capital asset line or the security market line, this is determined by the equation of the rate of return I is equal RF plus beta times RM minus RF. Whereas this is the required rate of return equal the risk-free. This area is the risk-free plus beta. Beta is the slope of this point RM minus RF. So this is RF, and this RM. This line is considered as the market return. And this point is equal the RM, this total, minus RF. We will have this point. And because, sorry? Yes, RF is the systematic. Yeah, the unsystematic. Okay? And we call this risk premium. This is risk premium. This is risk premium. And beta is the main component of the capital asset pricing model. And beta is a measure of systematic risk. Okay? Just to connect everything in the portfolio management or portfolio theory together, in the individual risk, as I said, standalone risk or firm-based risk is measured by sigma or by the standard deviation. But if we talk about this, the risk-free or by the systematic risk is measured by beta. So what is beta? We will talk about the importance of beta. As beta increases, the required rate of return for a given investment increases. Let's start here by the model, how they develop the capital asset pricing model. Okay. In terms of portfolio, the required rate of return of a particular portfolio is equal to the risk-free times the market return minus the risk-free divided by sigma m times sigma b. Let's see to classify or to address the problem of this. If you look back, if we have a portfolio located in here, see this is a portfolio. And this portfolio is a function of risk-free. So the return of this portfolio is equal to the risk-free plus this, okay, RM, okay, minus this area, we have this RF. Okay? So we will have this. Because the required rate of return of B is moving on this line, okay? So it's a function of the relationship between sigma B and sigma M. Later on, we will know the sigma B to sigma M is beta. Okay?
Sigma.
Okay. So now, the required rate of return of this point, the portfolio, is equal this plus this. Okay? Now, it's fine. This is RF. Okay? Plus, how you calculate this area is the market line. This is the RM, the market return. Okay? Minus RF. We will have this area. That's fine. Okay? Now, we need to calculate the slope. Because this is not coming like this. It's coming like this. It's moving in this way as a linear function. So to calculate this area, we need to calculate beta or to calculate the slope. Okay? The slope is equal tan theta. Now it's things complicated. Tan theta is the sine divided by the cosine. If you calculate the sine to cosine, you will have sigma b divided sigma m. Okay? I'm not asking to about this equation. I'm asking to the next equation because we will drive. Now, look at beta then. Beta of the portfolio, for instance, or any security is equal to the relationship between sigma I divided sigma m times rho I m. And this reminds you with the portfolio. You know, when we calculate the portfolio, the sigma B is rho, or the covariance is equal sigma I, sigma B, or sigma A, sigma B rho. So the beta, okay, is equal to sigma I, sigma M divided by sigma M rho IM. Thus beta depends on three factors. Again, before talking about beta, beta is the relationship between the market, the stock return and market return. If you talk about the beta of portfolio, is the relationship between the return of portfolio and the market return. Why it is a measure of systematic risk? Because it measures the exposure of a particular stock to the market risk. This is why it measures the systematic risk. The variability of the individual stock return, beta depends on the variability, means the risk of individual stock return. This is sigma I. And the variability of the market return, which is sigma M, of the market return, and the correlation. The correlation between sigma I and sigma M. Okay? If you back to the stock return, or to the sigma of return, the sigma of a particular stock, it measures the individual stock. But in the sigma B, or in the beta of B, is measured by three things. The standard deviation of the stock or the portfolio, the standard deviation of the markets. It means to what extent the sigma B responds to the changes in the markets, and the correlation between I and M, or between the portfolio and the markets. High stock betas should result in high expected return due to greater risk. If the market is expected to increase 10%, a stock with a beta of 1.5 increases by 15%. So it means the more betas, the higher the betas, the higher the rate of return and the higher risk. Okay, so we have many examples of beta. Amazon.com, Bank of America, we have General Motors, we have different examples of betas. Beta, no, we should finish, we have to finish. Beta and the security market line. RS, which is you can put the RS as RP or any, is equal to RM minus RF times beta. This is the most important model of the capital asset pricing model. The portfolio of beta, if we want to calculate the portfolio of beta, then RF plus RM minus RF times the beta. The beta of the portfolio is not as same as the sigma of the portfolio, because the beta of the portfolio is considering the correlation. So the good news of calculate beta, we don't need a very long equation. Okay? Take this example here, portfolio betas. If we have stock A, B, C, and D, the amount invested in each stock $100, $200, $300, $400, and the portfolio is 10%, just 100 divided by 1,000. The beta is like this. Now, what is the return of, or what is the beta of the portfolio? Beta of the portfolio. The beta of the portfolio is the weighted average of betas. The summation of the weighted average of betas. Okay? So, it's equal 0.10 times 0.9 plus, okay, where's the plus anyway? Okay, 0.10 times 0.9 plus 0.20 times 1.2 plus 0.30 times 1.60 plus 0.40 times 1.70. Okay? And we will have okay, we will go to fix this. Arbitrage pricing theory. The arbitrage pricing theory thinks the market is not efficient. Okay? Sorry? But in the short run. But in the long run, the market is efficient. The beauty of the arbitrage pricing theory is not considering only the underlying risk of a particular stock. It considers the other factors. The other factors can contribute to determine the return of a particular portfolio. Arbitrage pricing theory seeks to add additional variables to the explanation of security returns. It's not only related to the criteria of underlying stock. It's related to the general economic condition. And one more thing, you could have mispricing and you do arbitrage. You buy here and sell here, or you sell here and buy here. Arbitrage is the act buying a good or security and simultaneous selling it in another market at a higher price. You can buy in Gaza and you can buy it here and sell it in West Bank, or buy it in West Bank, because the price is not efficient. You can buy dollar in here, sell it in other areas. You can buy the euro here and sell it in other areas, because it's not in the all not having the same pricing. Arbitrage pricing theory states that the return on a security, RS, depends on the expected return, and on other assets. The good news, this is the last slide. The RS is a function of the risk-free, RE, plus the other functions, the betas of other functions, or the coefficient of other functions, function 1, 2, etc. Okay, so we end in this here, and thank you for your good listening. Okay.